This crash is going to cause a lot of clarity to form there. First, the community is getting educated, right? I bet you everybody in the crypto community today knows the difference between a dollar in the bank and UST. Mm-hmm. And I bet you they have an intelligent conversation about the difference between Circle and UST and the business model of the two. And mm-hmm. we saw last week, Tether had to redeem billions and billions of dollars of Tether, and they could, right? Mm-hmm. So they could. But if you'd actually tried to redeem $7 billion of UST in a couple of days, well, people tried to do that and they couldn't. So I think the industry got educated, but also I think that there's a lot of people that would like to issue stable coins, like Caitlin Long's bank would like to issue stable coins. And if you look at the banks like Silvergate and Signature, they're FDIC insured banks, but they can't issue stable coins. So, and if you look at JP Morgan and Goldman Sachs and Citigroup, they can't issue stablecoin. Now, if you roll the clock back 6 months, the president's working group put out a memo on stablecoins. And when they put out the memo, they said, we'd like for FDIC institutions to issue stablecoin. Now, putting aside whether you agree with that or not, there's been a regulatory deadlock on Capitol Hill.
Hello and welcome to Money Talks. In today's video, MicroStrategy CEO Michael Saylor updates about the recent crypto market turmoil and why it is wonderful for Bitcoin. The feverish price movement in the Bitcoin market does not appear to bother the executive who thinks that the stablecoin space needs more regularity. In fact, despite Bitcoin's struggles to stay above $30,000, he has another bold prediction for it. Make sure to stick around till the end of this video where Bitcoin evangelist Michael Saylor predicted that, despite the regulations, Bitcoin would rise to 10x. So, without wasting any time, let's dive right into the video.
For example, if you'd asked the same question to Jeff Bezos in 2003 and said, you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001?
Uh-huh. Yeah.
Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss.
Mm-hmm.
Do you wish he did?
That's true.
But you see how foolish that is, right? For example, Mark Zuckerberg, could have also sold Facebook, just before or just after the IPO and avoided a 50% loss. Uh-huh. In fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. So I think that trying to time the market is a trader mentality. But if you look at all the richest people in the world, they're not traders, right?
They're hodlers.
Yeah. Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, right? Larry Page. Name the person that traded their way to that situation. You can't really do it. Like trying to time the market is ridiculous. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days.
Yeah.
So if you miss the top 3 days of a year, you might lose 80% of your return. If you miss the top 6 days, you lose it all.
Yeah.
So the way this is going to work is it's going to look like you're not making a lot of money 98% of the time. And then you're going to wake up one day and you're going to find out that the sovereign wealth fund of some Middle Eastern country just bought $10 billion of Bitcoin. It's going to double or it's going to triple. And then you're going to be kicking yourself and screaming, saying, oh, well, I could have bought it at blank and I didn't buy it at blank. And you'll be angry.
Michael Saylor has a clear opinion on the Terra Luna crash and stablecoin space. He thinks that the crypto crisis and the UST crash both educated the existing crypto market and all investors on the notion of risk at the same time. Saylor thinks that you're certain to get diverse flavors of risk with 19,500 distinct types of coins. But how do you assess the risk? Given the current bear market, MicroStrategy CEO Michael Saylor spoke about the key reasons for the bear market, stating unequivocally that he is as bullish about Bitcoin as ever. He also stated that regulations will make Bitcoin 10x from here. In a world where everything is unpredictable, he claims that Bitcoin is the one thing that is certain. In a market full of upheaval and noise and fury, people need a safe zone to stand apart from the intrusion of a government, an agency, or a firm.
So I think that if we just take the example of stablecoins, that crypto crash and the UST crash has simultaneously educated the existing crypto market and all the investors. It's also introduced, the concept of risk. There are different, not everything is equal, right? There are 19,500 things, on CoinMarketCap, but they're not all equal. So to say, well, this is risk-free or that is, like they all have different flavors of risk, but how do you assess the risk?
May bought the death spiral for Terra and UST had greatly shaken investor confidence. However, according to Saylor, it will help with the regulation of stablecoins and security tokens. Additionally, he also stated that there is currently no suitable place to hide in these markets. Across the board, the market is in the bear territory. Bonds are not a safe haven, since they are currency derivatives. Stocks must boost their cash flows to keep up with inflation.
I think that the consensus is the regulators need to provide more clarity on this issue of stable coins, and they also need to provide more clarity on the requirements for a crypto security. Right? It's clear that Luna was a crypto security. The reason it's a security is there's an issuer and there's someone that can make decisions. And if I can actually make decisions, if I can take $3 billion and buy Bitcoin, and then I can take the same Bitcoin and sell it on behalf of the people that own the Luna token or on behalf of the people that own the UST token, I'm acting, kind of like a public company officer, and if you're a public company, like think about MicroStrategy. Like if I just sold all of MicroStrategy's Bitcoin and I didn't tell you, right? Or if I bought twice as much and I didn't tell you, I would be changing the nature of the security. I have, kind of an obligation to disclose that, an ethical obligation as well as a legal obligation to disclose what I'm doing when I can actually impact the value of the securities held by the public.
When it comes to regulations, Michael Saylor is quick to say that he despises regulators and that he is opposed to them doing anything because as long as they don't do anything, the industry will remain grounded at trillions of dollars. When they do something, you'll see people like David Solomon, who is the CEO of Goldman Sachs. Whatever Goldman Sachs thinks, JP Morgan thinks, Citigroup thinks, Bank of America thinks, and Wells Fargo thinks. So what he says is that, while we know the crypto economy is here to stay, we can't custody it. Yet they are afraid of the custody of these assets. This is what creates panic in the market by public traded figures.
You've got $300 trillion worth of money, that's $100 trillion of bonds, $100 trillion of equities, $90 trillion of currency derivatives, all sorts of forms of money. You've got other sorts of derivatives. They're all sitting out in the mainstream economy. And if you might have seen my tweet of Ken Griffin. Ken Griffin gave a speech last week to Bloomberg, and they asked him about crypto, and he said, look, the market deserves clarity from the SEC or the CFTC. What's a security? What's a commodity? And every day, ETFs publish their holdings. If you own it, and there's thousands of ETFs. ETFs are kind of like they're derivative securities of sorts. So, if I can buy an ETF and every day they tell me what their holdings are, then I can get comfortable trading it, shorting it, going long it, holding it, et cetera. So his view was, why can't we see the same disclosure on something like a stable coin, right? We should get some periodic disclosure. And then he ended his discussion with kind of like a degree of frustration, like it's overdue, like it's time to stop screwing around. And if we have regulatory clarity, it's going to open the way for tier one firms like his own, like Citadel. But what he really means is Goldman Sachs, JP Morgan, Citigroup, Bank of America, Wells Fargo, Citadel, all of Wall Street. It'll open the way for them to make markets, do research, right?
Mhm.
And to provide liquidity. And provide liquidity eventually means loans and as well as hold on their balance sheets.
According to Saylor, it is critical that regulators begin defining what constitutes a crypto security commodity or property as soon as possible. When these definitions are clear, investors will know exactly what they are getting into, and multinational financial institutions such as JP Morgan Chase, Citigroup, Goldman Sachs, and others will feel more comfortable expanding their involvement in this space. He believes that regulators need to clarify the issue of stable currencies, as well as the conditions for a crypto security right. Luna was clearly a crypto security, given there was an issuer and someone who could make judgments. According to him, the regulation of crypto securities would be accelerated because many of them are unregistered securities with no transparency.
I don't think there's any consensus or any interest anywhere in the Western world for a central bank digital currency. I don't think the banks want it. It would undermine them. I don't think the population wants it. The banks would look at it as an encroachment on their business. Like
Right.
Goldman Sachs, JP Morgan don't have a reason to exist, right? So they're not going to want it. And I think that the consumers and the voters don't want it because they think it's an encroachment on their freedom and their sovereignty. So I don't think anybody's going to trust that. With regard to which, if you look at all the existing stable coins, there's not a single one that meets the definition of the president's working group. So there's a debate going on throughout the world. And I think that the answer to what would I trust depends on who I am. If you ask the question, what will a big publicly traded company trust? A publicly traded company would trust a stablecoin issued by an FDIC insured bank. So for example, MicroStrategy is not going to hold either Circle or Tether or DAI or a UST type thing on its balance sheet because none of those meet the standard of an FDIC insured bank. And from our point of view, all we're wanting to do is move money from point A to point B with no risk. And so there can't be more risk than having the money in a Bank of America or Goldman Sachs. Now, if you look at other players, right? If you're a private company offshore, if you're a company in Venezuela or Argentina or Lebanon, then would you take the FDIC stablecoin? Sure, you would. But you might also take a public company like Circle. If there's a company that publicly issues and they disclose it, I mean, do they disclose it every month, every quarter, every week, every day, continuously? Right? There's an interesting question there, but you might take that. That's kind of like, holding a credit instrument from Visa or American Express or something. You might take that if there were additional services, right? Maybe you think that that's a safer thing than putting the money in your own local bank.
So what do you think about stablecoins? Are they a safe investment option or not? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.